Welcome to a new episode on the Gap Advisors Ind AS Clinic podcast. We're really glad you're joining us today because we have a fascinating deep dive lined up.
We really do. And it's one of those topics that seems so simple on the surface, but gets incredibly complex very quickly.
Exactly. When we think about precision, our minds usually gravitate toward the physical sciences,
Oh,
right?
for sure.
Yeah.
Physics, chemistry, things like that.
Yeah, like we picture atomic clocks measuring the decay of cesium atoms, or those incredibly sensitive glass-encased scales in a pharmaceutical lab.
Right, where literally a fraction of a milligram could ruin the whole experiment.
Exactly. A fraction of a millimeter or a millisecond is the literal difference between a breakthrough success and an absolute catastrophic failure.
It's totally binary. It either works perfectly or it doesn't.
Right. And I think, generally speaking, we expect that exact same level of absolute binary precision when we look at a publicly traded company's financial statements.
Oh, absolutely. It's a very common illusion.
Yeah.
People just assume that financial reporting is inherently binary.
We operate under this collective illusion that accounting is just, well, applied mathematics.
Yeah, the assumption is that the cash is either in the bank account or it isn't. The expenditure happened on a Tuesday or it didn't.
We want it to be that simple.
We really do.
Yeah.
People look at a balance sheet and assume they are looking at this high-resolution photograph of a company's financial reality at a specific millisecond in time.
We crave that mathematical comfort. We want to be able to run our finger down a beautifully formatted ledger, point to a specific cell on a spreadsheet, and say, there it is. That is the indisputable truth.
But it's really not a photograph at all.
No, not even close. The moment you step out of the raw data and into the world of corporate disclosures, specifically, the management commentary and the accounting policies, that perfectly calibrated atomic clock just shatters.
It really does. You realize you aren't looking at a high-resolution photograph. You're looking at a watercolor painting, and the management team is holding the brush.
That is a terrifying thought if you're an investor. We end up navigating a reporting landscape that is just incredibly murky.
The diagnostic waters are thoroughly muddy. And what we find time and time again when tearing down these annual reports is how often that deliberate murkiness is just hiding in plain sight.
Right. It doesn't look like fraud, does it?
Not at all. It looks like standard, boring, sleep-inducing boilerplate text. It is literally designed to make the reader's eyes glaze over.
Which sets the stage perfectly for today's focus. So for everyone listening, today we are going to dissect one of those perfectly camouflaged eye-glazing sentences.
We're taking a really close look at the fine print.
Yeah, we are plunging into the intricate nuances of Indian accounting standards to look at how a single, seemingly harmless sentence regarding a voluntary retirement scheme can systematically dismantle multiple core principles of financial reporting.
But before we start tearing apart the specific policy, we really need to anchor this discussion with some baseline context.
Good point. We need the ground rules first.
Right. To ensure everyone listening is fully oriented to the reality of the numbers we are discussing today, we are operating within the standard Indian corporate reporting period.
Which is very specific.
Yes, that timeline runs strictly from the 1st of April through to the 31st of March. And that rigid boundary is going to become highly, highly relevant in a few minutes.
Oh, I know it is. The March 31st deadline is everything.
Exactly. Furthermore, the functional currency and the presentation currency for the financial statements we are analyzing is the Indian rupee.
So it's all in INR.
All in INR. Consequently, any currency interacting with these statements other than the Indian rupee is strictly classified and treated as a foreign currency under the standards.
Okay, that makes perfect sense. So let's trace the origin of today's deep dive because, this is not some academic hypothetical we dreamed up in a whiteboard session.
No, this is real life. This is a real company.
It is. The observation we are about to analyze comes directly from the published Ind AS financial statements of an actual, currently operating listed company.
And we should mention how we found it.
All right. These financial statements were downloaded and independently reviewed by Gap Advisors on a suo motu basis.
Which means they just went looking for it.
Exactly. They didn't wait for a whistleblower or a regulatory red flag. They just went into the public domain, pulled the published documents, and started applying a magnifying glass to the fine print.
And for those in our audience who prefer to read along or, who want to see the underlying documentation of this specific accounting failure, this observation was completely laid out in a recent newsletter.
It was. It was featured in the 219th edition of the Gap Advisors Task Weekly newsletter.
Which is just a fantastic resource.
It really is. That specific analysis is authored by C.A. Meneshes-Iyer, Director of Gap Advisors, and it's published directly on LinkedIn.
I read it the day it came out. It's incredibly detailed.
I cannot overstate what an incredible resource that newsletter is for professionals in this space. I mean, they have published over 230 editions of that newsletter to date.
Over 230 deep technical dives. That's a lot of free knowledge.
It's massive. If you are on LinkedIn and you want this caliber of technical, standard-backed analysis showing up in your feed every week, you absolutely need to subscribe to the newsletter for free.
It's practically a masterclass in reading between the lines of corporate reporting.
Truly. Now, before we read this infamous sentence aloud, we must establish our mandatory guardrails.
Right, the disclaimer. We have to do this. The views expressed in this deep dive are the personal views of the author and are absolutely not binding on the audience.
Important to remember.
Yes. We strongly request that you, the listener, seek the help of an expert before taking any action or refraining from any action based on the views and technical interpretations discussed herein.
Perfect. With that out of the way, our mission for this session is highly targeted. We're going to isolate one specific sentence from a listed company's accounting policy.
Specifically regarding their voluntary retirement scheme, or VRS.
Right, the VRS. Our goal is to uncover the exact mechanics of how this solitary sentence manages to violate multiple fundamental Ind AS principles simultaneously.
It operates like a magic trick, an accounting sleight of hand.
So let's put the red flag right on the table. Here is the exact policy as drafted, approved, and reported by the listed company. Quote, expenditure on voluntary retirement scheme, VRS, is charged to the statement of profit and loss when incurred. End quote.
I mean, if you were to survey 100 casual investors or even junior analysts reading through a 200-page annual report at midnight.
And we've all been there at midnight.
Right. 99 of them would read that exact sentence and just keep right on scrolling.
Well, absolutely. On the surface, it uses all the familiar financial terminology. It sounds perfectly reasonable.
It sounds utterly benign. Charged to the statement of profit and loss when incurred.
It really does. But when you slow down and actually look at the mechanics of the phrasing, it reminds me of, it reminds me of lending money to a friend who is notoriously bad with their personal finances.
Oh, that's a dangerous game.
Exactly. You pay for their lunch, and they look you in the eye and say, thanks so much. I promise I'll pay you back when I get the chance.
Which means you are never seeing that money again.
Never. But it provides the illusion of a definitive plan, right? I will pay you back. But the phrase, when I get the chance, lacks any measurable trigger.
There's no date attached to it.
Zero. There is no deadline. There is no structural commitment. When I get the chance could mean tomorrow after payday, or it could mean 3 years from now when they finally remember and feel guilty about it.
Right. And in the highly regulated world of corporate finance, that phrase, when incurred, operates with the exact same evasive elasticity.
It's so slippery. So why is the word incurred such a massive red flag in this specific context?
The trap lies in the distinction between a chronological, verifiable event and a conceptual, subjective outcome.
Okay, break that down for me.
Well, the word incurred, standing alone in a policy without a defined trigger, is not a date on a calendar. It is a conceptual state of being.
A state of being. That sounds more like philosophy than accounting.
Exactly. When management writes that an expense is recognized when incurred, they are utilizing incredibly vague language. It leaves the primary user of the financial statements, whether that's a retail investor, a sovereign wealth fund, or a bank, in total doubt.
Doubt regarding what, exactly?
Regarding the actual physical timing of the expenditure hitting the books.
Because incurred doesn't actually tell the reader what the real-world trigger mechanism is.
Precisely. It just says, we will recognize the expense when we feel we have experienced the expense.
That is wild. Let's ground this in the brutal reality of how a voluntary retirement scheme actually unfolds inside a massive corporation. Because a VRS is not a single transaction, is it?
Not at all. It's not like going out and buying a piece of machinery where you hand over cash and get a title.
Right.
A VRS is an incredibly complex, multi-layered human resources and financial process. It stretches out over months.
Think about the timeline. If a company is doing a 50 crore VRS payout, does this specific company consider the expenditure incurred the very moment the board of directors sits in a room and signs a resolution approving the scheme?
That's one interpretation, sure.
Or Do they consider it incurred 3 weeks later when the HR department finally gets around to sending out the company-wide email officially offering the severance packages to the affected division?
Right, because that's when the employees actually find out about it.
Or does the trigger happen even later? What about the moment the employee actually reads the offer, consults with their family, and signs the physical acceptance letter?
That is a distinctly different legal moment than the board simply authorizing the budget, isn't it?
It is entirely different. You've gone from a corporate plan to an individual legal contract.
Or we can push it further down the timeline. Does management believe the expenses incurred only when the final sign-off is given by the executive suite?
Like after they have reviewed the aggregate number of applications and realized the total financial damage?
Exactly. Or, taking it to the absolute extreme of cash basis thinking, does the company define incurred as the exact millisecond the electronic funds actually leave the corporate bank account?
And hit the ex-employee's personal savings account.
Wow. Depending on the sheer scale of the enterprise and the number of employees involved, the gap between the board authorizing a massive VRS and the cash actually clearing the banking system could be, what, a 90-day window?
Easily. It could easily cross over a quarter-end reporting boundary.
And far more dangerously, it could straddle that critical March 31st financial year-end boundary we talked about earlier.
That is the real danger zone. The board could approve it on March 10th, the employees could sign on March 28th, but the cash might not go out until April 15th.
Which brings us to the core motivation behind this kind of drafting. We have to look at who benefits from that structural ambiguity.
Management always benefits from ambiguity. By deliberately leaving this policy open-ended, the management team is essentially writing themselves a blank check for earnings management.
A blank check to just move numbers around. Exactly. They retain the unilateral power to define what incurred means in retrospect, depending entirely on what narrative suits their current quarterly earnings targets.
Let's walk through what that earnings management actually looks like in practice. Let's play out a scenario. Let's say we have a CFO who is looking at a miraculously profitable quarter.
Okay, so a great quarter.
Right. Sales are through the roof, they've crushed all the analyst estimates, and they actually have, quote-unquote, too much profit.
Which is a good problem to have, but it sets expectations too high for the next year.
Exactly. They know next year is going to be tough, so they decide to take what the industry calls a big bath.
Ah, the big bath.
They want to dump as many bad expenses into this current, wildly successful quarter as possible to clear the decks for the future. With this vague policy, they can look at the VRS and say, you know what? The board approved the idea yesterday. Let's call the expense incurred right now.
Let's take the massive 50-core hit against today's massive profits. Yes, that happens all the time.
Conversely, let's look at the dark side of that same coin. Imagine that same CFO is having a disastrous quarter.
Revenue has dried up, margins are shrinking.
Right, and their annual bonus is directly tied to hitting a specific earnings per share target by March 31st. A 50 crore VRS expense would absolutely obliterate their EPS and tank the stock price.
It would ruin them. So, under this vague when incurred policy, that CFO can simply declare, well, we haven't actually transferred the cash to the employees yet, therefore the expense hasn't been incurred.
And just like that, they push that 50 crore liability into the first week of April.
They have successfully hidden a massive looming liability from the current financial year. The investor reading the March 31st balance sheet is looking at a complete fiction.
A totally manufactured reality. They think the company is fundamentally healthier and far more profitable than the underlying economic reality dictates.
The primary user of the statement is completely blind. They have no idea which of those timelines the company is utilizing.
Or if the company is actively switching the definition of incurred from year to year just to smooth out their earnings volatility. It's a system built on shifting sands.
But you see, the standard setters, the regulatory bodies who draft these accounting rules, they are intimately familiar with this exact breed of corporate behavior.
They aren't stupid.
Not at all. They study human nature, they study the incentive structures of executive compensation, and they know that if you give a management team an inch of elastic terminology, they will stretch it into a mile of earnings management.
So what's the regulatory countermeasure?
This is the precise reason why Ind AS 19 was authored. The standard exists to confiscate that blank check, remove the guesswork, and replace subjective conceptual outcomes with rigid, undeniable triggers.
Okay, let's open up the standard. Ind AS 19 governs the wildly complex world of employee benefits, right?
Correct. And this is where the company's carefully crafted, vague policy violently collides with the actual mandated rules of severance accounting.
So where do we look specifically?
We need to focus specifically on the mechanics of paragraph 165 within Ind AS 19.
Paragraph 165, what does it say?
Paragraph 165 is the absolute antithesis of vague. It strips away all management discretion regarding timing. The standard explicitly dictates that an entity shall recognize a liability and the corresponding expense for termination benefits at the earlier of two highly specific, rigidly defined dates.
Wait, the earlier of two dates, so they don't even get to pick the later one to delay it.
Exactly. We're no longer talking about conceptual timelines. We're talking about hard, chronological triggers.
So the standard forces the company to monitor two separate conditions, and whichever one happens first instantly traps the company into recognizing the massive expense.
That's exactly how it works.
I want to try and deduce what these triggers are, because if I'm a standard setter trying to prevent a CFO from playing games with the timeline, I'm going to look for a legal point of no return.
Right, a point where they can't back out.
Exactly. I would want to pin the company down the very second they lose the power to cancel the severance program.
You have just perfectly articulated Condition A of paragraph 165. The standard dictates the expense must be recognized, quote, when the entity can no longer withdraw the offer of those benefits.
No longer withdraw the offer. Man, that phrasing is a masterclass in legal precision.
It leaves no wiggle room.
So the standard doesn't care when the cash leaves the bank. It doesn't even necessarily care when the employee signs the paperwork if the company was already legally bound to the offer before the ink dried.
That is correct. The standard is designed to identify the exact moment an unavoidable obligation is born.
So when does that usually happen in a VRS scenario?
Once an entity has formally communicated a termination plan to the affected employees, and that plan outlines specific criteria like who is eligible, what the payout formula is, what the timelines are, the entity typically loses the legal or constructive ability to just change its mind and pull the offer off the table.
Because they've created an expectation.
Exactly. The moment you cross that Rubicon, where you are constructively or legally bound to execute those payouts, regardless of what happens to your quarterly profit targets, that is your hard trigger date.
And management's discretion is entirely evaporated. You announce the detailed plan, you are legally bound, you take the hit on the P&L that day.
A day. No delays.
That establishes a concrete anchor.
Right.
Okay, so what constitutes the second trigger? What is Condition B?
Condition B addresses scenarios where the severance isn't just an isolated HR initiative to trim middle management, but is rather a component of a much larger structural upheaval.
A structural upheaval, like a merger or a shutdown.
Exactly. Condition B states the trigger is when the entity recognizes costs for restructuring that is within the scope of Ind AS 37 and involves the payment of termination benefits.
Okay. Let's quickly define the boundaries of Ind AS 37 for you listening at home, because that's another heavy standard. Ind AS 37 deals with provisions, contingent liabilities, and contingent assets, right?
It does. It governs how companies account for future probable obligations that have uncertain timing or amounts.
Like a massive lawsuit settlement. Or in this case, tearing apart the corporate structure.
Imagine a scenario where a manufacturing conglomerate decides to shut down an entire unprofitable factory division.
Okay, so that's a big deal.
Massive. This isn't just a handful of early retirements. It involves breaking commercial leases, paying penalties to suppliers, selling off heavy machinery in a fire sale loss, and of course, rolling out a massive voluntary retirement scheme to 1,000 unionized factory workers.
That is a logistical and financial nightmare.
Under Ind AS 37, once management drafts a detailed, formal plan for that massive restructuring and raises a valid expectation among those affected, perhaps by issuing a press release or holding a town hall announcing the closure, they have created a constructive obligation.
Meaning they can't pretend it's not happening anymore.
Exactly. They are legally mandated to instantly recognize a provision on their books for the total estimated costs of that entire restructuring.
All the lease breaks, the penalties, everything.
Everything. And Condition B of Ind AS 19 simply closes the loop. It dictates that the very moment you are sourced to recognize that massive Ind AS 37 restructuring provision, you must simultaneously recognize the specific termination benefits expense embedded within that restructuring.
And Ind AS 19 demands that the CFO look at the timeline of Condition A, the point of no return on the offer itself. And the timeline of Condition B, the triggering of the broader restructuring provision, and mandates they select the earlier of the two dates.
The earliest possible point in chronological time when the obligation morphs from a theoretical plan into an unavoidable economic reality.
It's bulletproof. Now, contrast the razor-sharp, unavoidable precision of paragraph 165 with the listed company's single, airy phrase, when incurred.
It's almost funny when you put them side by side. The company's policy is built out of smoke, while the standard is built out of reinforced concrete.
But, I want to play devil's advocate here because I can hear a skeptical listener, perhaps a corporate controller or a CFO, who is just exhausted by regulatory pedantry, arguing against the severity of
Oh, they
this.
argue against it all the time. What's the argument?
They might say, look, if a company is going through a massive factory shutdown or they've publicly announced a massive VRS, the entire market knows the cash is eventually leaving the building. Everyone from the institutional investors down to the retail day traders knows the company is on the hook for those payouts.
True. The market prices it in somewhat.
Right. So they'd argue, why does the exact hyper-specific earlier date matter so intensely? Isn't it ultimately just a debate over timing within a 12-month window? If the 50 crore hit eventually washes out through the P&L by the end of the year anyway, is it really that catastrophic of a reporting failure?
That argument fundamentally misunderstands how modern financial markets actually digest information. It is a catastrophic failure because, in the realm of financial reporting and valuation, timing is not just a secondary characteristic of the picture. Timing is the entire picture.
Timing is everything.
Let's look at the mechanics of capital markets. Companies do not report their performance in multi-year blocks. They report quarterly.
Right. The quarterly earnings call is the heartbeat of the market.
Exactly. Analysts at major investment banks build highly sensitive discounted cash flow models, and they value publicly traded companies based heavily on quarterly performance trajectories.
So a small shift matters.
Hugely. If you are dealing with a VRS scheme that costs 50 crores, the decision to shift that specific 50 crore expense across a quarter boundary entirely rewrites the narrative of corporate profitability for that critical 3-month window.
I mean, a 50 crore artificial swing in operating profit is more than enough to be the sole difference between a company beating the Wall Street expectations and triggering a massive stock rally versus missing expectations and causing a brutal double-digit sell-off.
The stakes are incredibly high, and the distortion becomes exponentially more dangerous if we are talking about manipulating the March 31st annual boundary.
Right, the end of the financial year.
If Condition A, that legal inability to withdraw the offer, crystallizes on March 15th, Ind AS 19, demands the company recognize the massive liability and take the profit hit in that current financial year.
But if the company relies on their illegal, vague policy.
Yes, if they decide they haven't incurred the expense until the employees actually countersign the final HR paperwork on April 10th, they have successfully perpetrated a massive distortion.
They pushed it into the next year.
They have hidden a 50 crore liability and a 50 crore expense from the audited annual statements. A sovereign wealth fund analyzing that March 31st balance sheet is going to calculate debt-to-equity ratios, profit margins, and liquidity metrics based on numbers that completely ignore a massive, unavoidable cash outflow.
Because it's literally not on the paper.
Exactly. By blatantly ignoring the rigid, non-negotiable triggers embedded in paragraph 165, the company's when incurred policy represents a fundamental systemic failure to comply with Ind AS 19.
They deliberately opted for a word that provides them with maximum elasticity, whereas the legal standard strictly demands a concrete wall.
They have comprehensively failed on the measurement and recognition front. They fail to acknowledge when the financial hit takes place. But the cascading failures of this single sentence do not stop at the dimension of time.
No, they do not. This single sentence is like a nesting doll of accounting violations. You open up the timing violation and there's another completely different violation just hiding inside it.
The company didn't just fail on the chronological timing of the expense. They also failed on the architectural mapping of the expense.
The architectural mapping.
Yes, they failed to explain exactly where that massive financial hit is physically located within the architecture of the financial statements.
Let's dissect this presentation problem. If we reread the exact phrasing of the company's policy, the back half states that the VRS expenditure is, quote, charged to the statement of profit and loss.
To understand the depth of that specific violation, we have to pivot away from Ind AS 19 and bring in the overarching rules of presentation.
Which standard is that?
specifically paragraph 10A of Ind AS 1, which governs the presentation of financial statements.
What is the mechanical requirement of paragraph 10A? Because to a layman, saying an expense goes to the statement of profit and loss sounds like you are giving directions to the right building. It sounds complete.
It's not complete at all. Paragraph 10A mandates the exact internal architecture of how that statement must be constructed. The standard explicitly states, an entity shall present a single statement of profit and loss, with profit or loss and other comprehensive income presented in 2 sections.
So it's one statement, but divided.
Exactly. The standard goes on to say, the section shall be presented together, with the profit or loss section presented first, followed directly by the other comprehensive income section.
Okay, so the standard forces companies to split their statement into 2 distinct, fundamentally separate buckets. You have your core profit or loss bucket and your other comprehensive income, which we frequently abbreviate to OCI bucket.
The statement operates as a single continuous document, but it is bifurcated to reflect 2 entirely different economic realities.
So pointing our lens back to the company's policy, they simply stated the VRS expenditure is charged to the statement of profit and loss. They gave us the name of the building, but they absolutely refused to tell us which room the expense is sitting in.
That's a great way to picture it.
It feels like telling a food delivery driver that you left their cash tip somewhere inside the house instead of specifying it's on the kitchen counter.
Good luck finding that tip.
Right. The house has fundamentally different rooms with completely different purposes. Is the cash in the living room? Is it buried in the basement under a pile of laundry? Saying it's in the house is factually true, but it is entirely unhelpful and, frankly, borderline antagonistic to the person desperately trying to find it.
That analogy perfectly captures the frustration of an analyst trying to parse these statements. In the intricate world of financial analysis, the different rooms of the statement of profit and loss serve radically different valuation purposes.
Let's talk about the first room, the core profit or loss section.
Items that are recognized in the core profit or loss section impact traditional headline-generating bottom-line metrics directly. This is the section that dictates your net income.
A big number.
This dictates your core earnings per share. When financial news networks flash a company's quarterly results on the ticker tape at the bottom of the screen, they are pulling numbers straight from this specific room.
That is the highly visible, closely guarded operating core of the company. It's the number every executive's bonus is tied to.
Conversely, items that are mandated to hit other comprehensive income, or OCI, are handled with a completely different methodology.
OCI is a weird concept for a lot of people. What actually goes in there?
The OCI section is designed to capture items of income and expense that are not permitted to be recognized in the core profit or loss by other specific Ind AS standards. We're usually talking about highly volatile, often unrealized paper gains and losses.
Unrealized, so not actual cash flow events.
Right. Things like revaluation surpluses on property or actuarial gains and losses on complex, long-term defined benefit pension plans, or foreign currency translation reserves.
Stuff that swings wildly from year to year.
Exactly. Standard setters created OCI because they realized that forcing massive, non-operational, unrealized swings into the core P&L would make a company's operating performance look chaotic and completely unanalyzable. Crucially, items in OCI bypass the traditional net income metric entirely.
So they don't hit the earnings per share.
They do not.
The valuation implications of this are just staggering. If I am an analyst at a major fund trying to forecast a company's normalized forward-looking earnings power to figure out if we should buy the stock, I treat OCI items fundamentally differently than I treat core P&L operating expenses.
How so?
I might completely strip the OCI numbers out of my discounted cash flow model because I view them as non-recurring noise.
A lot of analysts do exactly that. And by deploying a policy that intentionally fails to specify which section is absorbing the massive VRS hit, the company thoroughly obscures the true nature of their accounting treatment. The reader's left paralyzed by questions.
Because you don't know if they're burying it. Is the company attempting to bury the massive severance expense down in the OCI section in a desperate bid to protect their core earnings per share and artificially inflate their stock price?
Or are they properly taking the hit in the primary profit or loss section? The user of the financial statement should never have to guess.
That's the whole point of standardization.
The entire architecture of Ind AS 1 exists precisely to prevent users from having to engage in speculative guesswork about the location of material expenses.
You know, the specific verb you just used, obscures, is perfectly deployed here because we aren't just engaging in a pedantic debate about grammar or formatting preferences. The deliberate act of obscuring information is not a minor faux pas. It is actually a severe regulatory violation explicitly defined and targeted by the accounting standard.
It is a targeted offense. This brings us directly to paragraph 7 of Ind AS 1, which tackles the insidious danger of companies hiding critical information in plain sight.
I want to look closely at paragraph 7 because the concept of obscuring information sounds almost poetic or subjective. But in the realm of regulatory enforcement, I imagine the accounting definition operates with strict, unforgiving parameters.
The definition is incredibly strict, and it is entirely focused on the psychological and analytical experience of the end user. Paragraph 7 fundamentally states that information is considered obscured if it is communicated in a way that would have a similar effect on the primary users of the financial statements to omitting or misstating that information entirely.
Wow. That is a staggering regulatory philosophy. I want to make sure you listening fully absorb the weight of that. The standard is explicitly stating that if a company writes down a policy, but writes it in a vague, confusing, or unhelpful way, the regulatory body treats that failure of communication with the exact same severity as if the company had completely deleted the policy from the document.
Or if they had outright lied and committed fraud.
The standard actually equates obscuring with omitting and misstating.
It is a profound shift in regulatory mindset.
Mm-hmm.
It moves the goalposts beyond the simple binary question of, did management physically print the number on page 84? And elevates the standard to, did management communicate the reality of that number effectively and transparently?
It's demanding actual clarity, not just compliance.
Yes. And to ensure this isn't just a philosophical debate, paragraph 7 provides a highly specific lump of examples detailing circumstances that automatically result in material information being classified as obscured.
Instead of just reading a dry list of examples from the standard, let's try to reverse engineer this from the perspective of a manipulative management team.
Oh, I like this. Okay, let's role play.
Let's say I am a shady CFO and I have a massive, embarrassing financial liability that I am legally forced to disclose, but I desperately want to ensure that no analyst actually figures it out. My first strategy would be to just use broad, non-committal language. I wouldn't lie, but I would refuse to be specific.
The standard anticipates that exact strategy. Example A explicitly flags situations where information regarding a material item or transaction is disclosed, but the language used is deliberately vague or unclear.
Which is the exact trap we are dissecting today. Saying an expense is recognized when incurred is the dictionary definition of vague and unclear. It provides the shape of an answer without any of the substance.
It absolutely fails example A.
Okay, what if I try a different tactic? What if I take the embarrassing information and I shatter it into tiny pieces? I put a footnote about the liability on page 40. I put the actual monetary value in a completely unrelated table on page 82. And I put the timing of the payout in the management discussion section way back on page 15.
Making the analysts work for it.
I make them play a terrible, exhausting game of corporate hide and seek.
That brings us to example B. The standard classifies information as obscured when details regarding a material item are scattered throughout the financial statements.
So they caught that too.
Yes. The company technically put all the puzzle pieces out there in the public domain, but they scattered them so widely that no reasonable user has the time or the ability to piece the cohesive picture back together.
All right, what if I try the opposite approach? Instead of scattering things, I just throw everything into a massive blender.
The blender strategy.
Yeah, I take my embarrassing legal settlement costs, I combine them with my standard marketing expenses, I throw in the cost of printer paper for the office, and I just create a massive line item called Other Miscellaneous Operational Costs. I hide the poison inside a giant bucket of normal expenses.
The regulators are waiting for you there as well.
Yeah.
Example C defines obscuring as when dissimilar items, transactions, or events are inappropriately aggregated. By throwing legal settlements in with office supplies, you completely destroy the visibility into the individual material components.
It just becomes noise.
Conversely, example D targets the reverse strategy when similar items are inappropriately disaggregated.
How does that work?
This is the death by 1,000 cuts approach, where a straightforward massive expense is broken down into 20 tiny, confusing subcategories to deliberately mask the total devastating impact on the bottom line.
So if my VRS was 50 crores, I split it into 50 tiny 1 crore lines called transition cost A, transition cost B.
Exactly. And the reader never sees the full 50-core hit in one place.
Okay, my final strategy. I call this the data dump. I have one terrible material number that I have to disclose, so I bury that single number inside a 60-page appendix filled with incredibly dense, hyper-technical, completely immaterial disclosures about minor subsidiaries that don't even matter.
Ah, burying them in paperwork.
I intentionally exhaust the reader so they give up before they find the hidden landmine.
That is the most insidious strategy of all, and it is explicitly captured in example E. The standard states that information is obscured when the understandability of the financial statements is intentionally reduced by hiding material information behind a wall of immaterial information,
Basically making it impossible to separate the signal from the noise.
to the point where a primary user is simply unable to determine what is actually important.
This feels like a massive paradigm shift in corporate accountability. I speak with management teams who frequently operate under this protective delusion that as long as they wrote something down in the document, they are completely shielded from liability.
We disclosed it.
Their defense is always, hey, we didn't commit fraud, it was right there in footnote 14. It's not our fault your analyst didn't read it correctly.
Does paragraph 7 effectively criminalize bad writing in financial disclosures?
It absolutely shifts the burden of communication onto the preparer. Intent is largely irrelevant. The measurable effect on the primary user is what the standard setters prioritize.
So it doesn't matter if they meant to hide it.
It genuinely does not matter if the management team was executing a malicious, coordinated conspiracy to hide the timing of the VRS payouts, or if the junior accountant tasked with drafting the policy was just tired, lazy, and copied a vague phrase from a decade-old template.
The result is the same. By deploying a vague, unclear, unspecific policy on a highly material item like a 50-crore voluntary retirement scheme, the company has officially and legally disclosed obscuring information.
And under the strict letter of Ind AS 1, that failure of communication triggers the exact same regulatory consequences as deliberately omitting the policy entirely.
Correct. It renders the disclosure functionally useless to the market. And in a capital market ecosystem that relies entirely on transparent, reliable data to allocate billions of dollars of capital, a functionally useless disclosure is an incredibly dangerous thing.
This brings us to the real-world, high-stakes application of everything we've just discussed. Because, we aren't just engaging in this deep dive as a theoretical academic exercise.
There are real consequences.
There is a deeply serious, practical reality to this. If you are listening to this session right now, and you are a statutory auditor, or you are a controller on a corporate finance team desperately trying to finalize these statements before a board meeting, your entire job is to catch these subtle, camouflaged errors before they are published to the stock exchange.
And the psychological pressure to get it flawlessly right is immense.
It's got to be exhausting.
The pressure on the modern auditor is almost unfathomable. The Ind AS standards are voluminous, they're constantly evolving, they're intensely complex, and as we've just seen with our breakdown today, a single lazy word like incurred, or a broad term like statement, can instantly trigger a massive cascade of non-compliance issues spanning multiple different regulatory standards.
How is one person supposed to catch all that?
They can't. An auditor out in the field staring down a combative CFO cannot possibly be expected to hold every single nuance, paragraph, and cross-reference in their head at all times.
Which is exactly why having access to actionable, authoritative resources isn't just a luxury, it's a fundamental survival tool. I want to highlight the platform that made the incredibly detailed analysis in today's deep dive possible. I'm talking about the massive issue repository built by GAAP Advisors, which you can access directly at gapadvisors.com.
It's an absolute game changer for auditors.
This isn't just some casual accounting plug. This is a highly technical, exhaustive database hosting over 4,500 specific issues and deeply researched responses covering the most brutal complexities of Ind AS and Indian GAAP.
It operates as an unparalleled knowledge base for the profession. And the most critical aspect of the platform is its accessibility. Any professional, student, or corporate team can register on gapadvisors.com for absolutely free.
Let's talk about how this practically alters the dynamic of an audit engagement. Picture an auditor sitting in a client's conference room. They are reviewing the draft financials, and they spot an accounting policy that sets off their internal alarm bells.
Maybe it's a vague one-sentence policy about severance pay that says, when incurred.
The auditor knows in their gut that it's wrong, but the CFO is pushing back, demanding the auditor prove it.
In that high-pressure negotiation, an auditor's only defense is the strength of their documentation. They cannot go to a CFO and say, I feel like this phrasing is inappropriate. They'll be laughed out of the room.
They need cold, hard proof.
They need ironclad, verifiable proof in their audit files detailing exactly how they address the complex application of Ind AS. If they're going to challenge a publicly traded company's VRS policy, they need to be able to instantly cite Ind AS 19, paragraph 165 regarding termination triggers, and Ind AS 1, paragraph 7 and 10A regarding presentation and obscuring information.
And that's where the platform steps in. By utilizing dopadvisors.com, that auditor can submit the specific complex issue they are facing, and they then receive a heavily researched, standard-backed, detailed response delivered directly to their registered email inbox.
It transforms a gut feeling into documented, authoritative proof. It empowers the auditor to walk back into the CFO's office, not with an opinion, but with an unassailable regulatory mandate.
It effectively puts a master technical desk right in your pocket, accessible from any audit room in the country. But the ultimate goal of the accounting profession shouldn't just be catching these violations after they've been drafted. The goal is outright prevention.
Always. Prevention is key.
If you are a finance professional, a CFO, or the head of a reporting team, your absolute highest priority should be getting your financial statements rigorously stress-tested and reviewed before you ever sign your name to them.
Prevention is infinitely cheaper and infinitely less painful than correction. Once a set of financial statements containing misstatements, hidden liabilities, or obscured information crosses the threshold and hits the public markets, the damage to corporate reputation, investor trust, and regulatory standing is permanent.
So how do you build that safety net? You can easily get your draft financial statements reviewed by the technical experts at Gap Advisors before the final signing.
Very simple process, really.
The process is remarkably straightforward. You finalize your draft financial statements, export them into a near-to-publishing PDF format, and submit them directly via email to info@dapadvisors.com.
Having an independent, highly specialized set of eyes review the document is invaluable. Eyes that are specifically trained to hunt for obscure language, vague timeline policies, and structural compliance gaps. It is the ultimate insurance policy before the market gets its hands on your numbers.
It functions as the ultimate sanity check. Because, as we saw with the policy we tore apart today, the internal teams drafting these statements are almost always too close to the material.
They suffer from proximity blindness.
Proximity blindness, I love that term.
They know internally what they meant to communicate regarding the VRS scheme, so their brains automatically fill in the blanks, and they genuinely don't realize that the 14 words they actually printed on the page are fundamentally structurally flawed.
The classic curse of knowledge. You know the truth, so you falsely assume your vague writing communicates that truth to a stranger. Let's pull all of these threads together and summarize the incredible journey we've been on during this session. We started with a single, unassuming sentence. Expenditure on voluntary retirement scheme, VRS, is charged to the statement of profit and loss when incurred.
Just 14 seemingly standard words.
14 words that, when placed under the microscope, managed to reveal massive, systemic failures in both the measurement of liabilities and the presentation of realities. It completely failed in AS 19 by arrogantly ignoring the strict, non-negotiable chronological triggers required for recognizing a severance liability.
Opting instead for the elastic, highly manipulative concept of when incurred.
Right, and it compounded that failure by violating Ind AS 1, failing to specify whether the massive expense was going to impact the highly visible core profit or loss section, or be quietly buried in the other comprehensive income section, leaving analysts entirely blind to its true impact on operating performance.
And to top it all off, it violated the most profound overarching principle of transparency by falling squarely into the standard's definition of obscuring information.
An act of miscommunication that regulators treat with the exact same severity as a deliberate misstatement.
It really is a phenomenal masterclass in exactly how much regulatory damage can be inflicted by a single, poorly drafted sentence.
It is truly astonishing. And it brings me right back to the idea we opened with. That expectation of the atomic clock, that assumption of pristine mathematical certainty we bring to financial reporting. We've seen unequivocally today that the scale isn't just occasionally broken. Sometimes the scale is deliberately carefully miscalibrated, using the boring camouflage of boilerplate language to hide the manipulation.
Which brings us to a final, slightly uncomfortable thought I want to leave with our listener today. A question to seriously mull over the next time you sit down to read an annual report a prospectus, or a quarterly disclosure.
I'm ready. What is it?
If a single, seemingly standard 14-word sentence about a retirement scheme can inadvertently, or perhaps highly intentionally, violate the most core principles of measurement and presentation, how many other boilerplate accounting policies in today's published annual reports are actually perfectly legal-sounding camouflage?
That is terrifying.
When you scroll through 50 pages of standard phrasing that you normally gloss over, how much of that text is actually a carefully constructed wall designed specifically to hide the true underlying financial realities from the investing public?
That is a deeply chilling but entirely necessary question. It fundamentally changes how you look at the text. It makes you want to read every single footnote, every single policy disclosure with a magnifying glass and a profound sense of skepticism. Thank you for walking us through that incredible analysis.
My pleasure.
And to you listening, if this deep dive opened your eyes to the hidden, manipulative complexities of financial reporting, we have a vital favor to ask. The widespread understanding and rigorous enforcement of Indian accounting standards is absolutely critical for maintaining a healthy, transparent, and trustworthy capital market. We strongly request that you share this deep dive among your professional contacts, your colleagues, and your entire audit and corporate finance teams.
And I would specifically request that you share this analysis with students who are currently pursuing the CA course. They represent the next generation of financial gatekeepers who will be tasked with untangling these exact types of reporting failures. Exposing them to this level of real-world, standard-backed application is invaluable for their professional development.
Absolutely. We need to spread the knowledge of Indian accounting standards as widely as possible. We want to formally thank you, the audience, for your time today and for joining us on this incredibly detailed, rigorous journey through the standards. To ensure you don't miss our future technical breakdowns, we request you to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. You can easily find us and subscribe on Spotify, Amazon Music, or YouTube, whichever platform you personally prefer to listen to the Gap Advisors Ind AS Clinic podcasts. Thank you once again for your dedication to professional excellence, and we will see you on the next deep dive.